Well, we have three major companies reporting this week, and this is consequential not just if you're a shareholder in Microsoft, Alphabet, or Meta, but even if you just hold the S&P 500 as an index, because those three stocks make up 12% of the S&P 500. And of course, we're going to get Amazon as well reporting. Oh gosh, I got to look up the calendar here at some point next week. So very consequential for these tech stocks as well as for the index as a whole, as we're sitting atop the highest level that we have seen for the S&P in more than a year. When we got the initial read of those so-called Magnificent Seven, Tesla, the reaction was to sell down the stock. Netflix, which is not technically a Magnificent Seven, but has been magnificent in its share performance, also pulled back when it reported quarterly results. Let's bring in Dan Rohinton, portfolio manager at IA Global Asset Management. You own three of the companies that are set to report this week. Are you getting nervous about the setup going into results?
You know what's funny, Amber? This has got to be one of the most optimistic positioning quarters we've seen in basically the last 2.5, 3 years. So positioning is very bullish. Positioning is very optimistic, and it's going to take a lot to really jump over that to really see an outperformance from what we've seen going into the quarter. And what you said about Netflix is the perfect case of what I like to call travel and arrive. It rallies into the quarter, and then it sells off, and we end up where we were 2-3 weeks before the stock even was going to report in the first place.
Which means it's kind of, running around to stay in place. You might get that kind of knee-jerk reaction, but ultimately, the thesis doesn't come undone. Is that what you think could play out with Alphabet, Microsoft, and Meta?
I think so, but I think you have to look out over the next few years and know that some of the gains that you would have seen in a more linear fashion actually showed up front. So I think some of these stocks have the potential, if they really can't get AI to represent a meaningful portion of their revenues in the next year or two, I think we're going to be more likely to mark time than to really see the fantastic returns we've seen so far in the first 7 months of the year.
Microsoft seems like it's ahead of the pack on that front because it has a product, first of all, and it has a pricing strategy, which is more than we can say for some of the others that are set to report. Do you think that means that they're the best position to deliver, concrete numbers and forecasts on the back of AI?
I think they're the middle of the pack, believe it or not, because what you have to remember about Microsoft and the expectation so far is what we've seen in the data and our research is the market's expecting 30, 40, $50 billion of AI Copilot revenue, which is what you were alluding to there, that $30 a month add-on to Microsoft's main product suite. Those are fantastically large numbers to meet in a year or two. And we're talking about 100 million, 200 million subscribers to get to that level. So I think Microsoft's middle of the pack in terms of expectations, but it just goes to show just the leaps and bounds you have to achieve to meet expectations in this environment today.
Microsoft's at an all-time high. Alphabet is 20% off of its all-time high. On a relative basis, does that make it an attractive stock, and maybe even for an AI play, which has so far been disappointing?
It's the discount AI play, and for no great reason, because they have fantastic AI technologies. They have cloud computing, the same as Microsoft. What they've lacked is the shine, the sizzle that Microsoft's done so well, but also the enterprise customers. So Alphabet's got to go one at a time, or shall we say big corporates at a time, versus at Microsoft, which basically makes it available to its 500 million users around the world, and they can instantly sign up for it. So I do think Alphabet's a discount play, but even Alphabet's expectations have been coming up.
Meta is interesting because, it was such a quick pivot from we're going to spend to we're not going to spend. And since that decision was made, kind of November 2020, the stock is up 230%. It's almost like a straight line up, really on cost cutting, some incremental penetration, I would say, on Instagram. But, what does this company need to demonstrate to kind of sustain this momentum, or at least not let it come out?
I think the most important thing, and you alluded to it, is that Zuckerberg's what he calls the year of austerity, the year of discipline continues, and it wasn't just a fleeting a state of mind for him, and that Meta continues to be disciplined on costs and CapEx. That's going to be a bit harder as AI is very compute and cost intensive before the revenues do show up. So that's the most important thing that the market's going to look for. In addition, and you also alluded to it with Instagram, TikTok, which was viewed as a big threat in the last year and a half, has now faded away and plateaued in its engagement, and Instagram's managed to maintain its momentum. So how engagement does and how Mark Zuckerberg's year of discipline does is really the setup into the quarter. But I'd say of the three that we've talked about, the expectations are by far the highest for Meta.
Do you think, as an investor, are you thinking about Threads, the rival to Twitter?
It's a nice compliment. You know, Twitter at its peak was maybe $40 billion that Musk took it out at. It's going to probably declare bankruptcy. There's a 50-50 shot in my mind about the Twitter bankruptcy coming up in the next few months. So Threads is great. Threads, it's incremental, but the real crown jewel is Facebook and Instagram and the subsidiary pieces of that, like Facebook Messenger and WhatsApp. So Threads is a nice compliment but for such a big company like Meta, it's just really the icing on the cake.
We're going to go back to that because you delivered that line very casually that Twitter is going to has a high chance, a 50% chance of going bankrupt. That's a $44 billion buyout, most of that or a lot of it, I should say, with debt.
Yeah, and I didn't mean to cause any sensational points there, but when you think about just the advertising revenue, which Elon Musk has said is down 50% since he took over, and they're not at cash flow positive. One of the dynamics actually we saw this weekend was the rebranding of Twitter to X, or the potential of that. That might sound like a Elon Musk eclectic move, but it could be, if you want to take a more, call it a legalistic view on it, it could be he's basically trying to hive off the Twitter brand, run the rest of the business into bankruptcy and emerge it and sell it as part of the actual core Twitter and rebrand it back. So I didn't mean to go too sensational with it, but when you're running cash flow negative, you have a high debt burden, and you're bleeding subscribers to Meta on the Thread side, then you start having to get more creative in terms of how you think about the other side of Chapter 11. So I see this as potentially, if nothing improves, I think it's inevitable.
I mean, too late. It's already a sensational headline. You're talking to a journalist, so I'm going to take that and run with it. Is that going to be game-changing for Meta? Is that going to be just more incrementally positive?
It's an incremental positive. It's not too much more than that. Meta has too big of a revenue base and too much diversification for even Threads. If it's a standout success story, it'll be maybe a small cousin to Instagram proper. So it's really marginal to Meta, but it's very material to Twitter and that community that's developed there.
Okay, I do have to let you go, but I want to talk about, we talked a lot about tech. Just where is tech ranking right now in terms of your allocation? Are you still overweight, or are the other sectors getting more interesting? Because we've seen this rotation in the last month away from tech and into other sectors.
So it was an overweight for us. We brought it down to a neutral, and we're on our way to underweight. And it's not because of the fundamentals. The fundamentals are robust and strong. It's just the mountain of expectations is so high that you need to have a record-setting second half and one of the best years for the NASDAQ ever to maintain the current momentum. So we'd fade it, and that'd be our recommendation, but understand that we're catering to a more conservative client base.